Hey everyone, welcome to another episode of the Index Podcast, where we come together every couple of weeks to discuss on-chain data, chart crimes, and metrics that move the crypto industry. Today I have with me Hildobi, resident data house elf at Dragonfly.
Hello, everyone.
Danning, chief on-chain sleuth at Pantera Capital.
Hi.
And I am Boxer, and I am the community powers at Dune. Before we start, nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. We are acting independently of our respective professional roles. And with that, today we have an episode on tokenization. Danning and her team at Pantera Capital are currently cooking up a research report on, I think, the state of tokenization is how you call this. So we're just gonna, while Danning is in the context, we're gonna get the content fresh off the press before the report is even launched. So Dobby and me are gonna ask some stupid questions here. We've not been able to take a look at the actual report, but we'll just listen to Danning explain to us what the state of tokenization is.
Yeah, I mean, how was ECC for you guys? I think it's relevant, right? I heard there's a lot of suits there, and there's a lot of institutional people there. Was the topic a lot of RWA as well?
I was more on the usual dev side of ECC, so that's not where you see the suits. That's where you see the dev, Nothing changed dramatically there, but there was definitely a whole other section that was more suit fitting, I guess. There was even a side event called Agora, which was pretty big, and yeah, maybe Florian has more info there actually.
Yes, Florian is on his crypto BD talking to TradFi arc. If anyone saw me during the week, I was wearing like a finance bro vest that has Dune embroidered on it. We're now very seriously in the category of we're selling data to these institutions. So yeah, very very different ECC from me from last year, which is I'm now very much less interested in the dev side, and we are a lot more interested in kind of like the TradFi side. So I actually went to that Agora event and I felt catastrophically underdressed. And I was, for my intents and purposes, I was wearing a dress shirt and my finance bro vest, and like no, people were rocking like full suits, leather shoes, like it was crazy. So I mean, it's not crazy. It's like that's a professional conference, but for me this was quite unusual, let's say. And they had like speakers from whatever Bloomberg and S&P, like how's this called, Standard & Poor's, the like rating agency. They now have like a framework to like digitally license their S&P 500 index on the Canton chain or something like this. Don't nail me down on the details, but like there's like a lot of kind of like TradFi players that are moving on chain, and like they're moving into the space, and kind of like they're interested in roughly like, okay, it's like a lot of financial engineering at the end of the day. Like how can we re-hypothecate like the US bonds that we emit, and then kind of like you can put them into a lending protocol, and then you can loop them, and thereby you have like 5% more yield or whatever, which the DeFi veterans of 2021 would scoff at 12% yield, but in TradFi, like even like 5 basis points more yield or like 50 basis points more yield is like an insane like an efficiency gain. So for these people, this is all very exciting, and I think for us it should also be very exciting, where we are now just kind of like becoming the backbone of both like modern fintech infrastructure on the one side, and then on the other side, kind of like more traditional financial players are now moving on chain with their stacks, with their tech stacks. So like they're basically like leapfrogging like a whole era of technology, where they're just straight going from COBOL to now being on chain. Which is pretty cool to some extent. But yeah, definitely a learning experience. I'll have to buy some suits, I think, if I want to be successful at conferences going forward, to actually kind of like do the BD stuff. And yeah, I feel like the vibe shift was like quite significant. Like I've like from my perspective, I've been yapping for a long time, and let me stop in a second. But I think like I ran the take of like, I'm just working in fintech now. Like I wore my finance bro vest the entire week, and like there was not a lot of people that would actually kind of like fully agree with me. I think like I had like very mixed reaction. That I just used it as like a conversation opener. Like I just kind of like run this take by like quite a few people just to like get reactions and like try to see where the industry's at. Which is like what I use conference mostly for. Is like I try to like gain as much context, gain as much information as possible. And I feel like there's like reasonable infrastructure builders who've like, they see this, they understand this, they know this. It's usually kind of like the bigger companies who are like, okay, everyone else has gone bankrupt. They don't have any money anymore. The chains have all died. Like, where's the money coming from? It's like, yeah, TradFi is the new game in town. Like, we actually need to make some money. And then then there's like a category of like, I feel like, how would you say this? Like, after World War II, there was a few Japanese soldiers on some isolated islands that would just fight on for the emperor until like 1949 or something. I think the craziest one only surrendered in like 1957 or something like this. And I feel like there's a lot of people in the crypto industry who are essentially like Japanese soldiers on like some on some Philippine island, who are just like they haven't heard the news that like, oh no, like Web3 is that, and like we're not gonna have social fi and NFT fi and like all of these things, but rather like, nah bro, like we just find fintech infrastructure now, and that's actually okay. But yeah, I think there's like a rift in the narrative where like some people are like very frankly like they're just realistic and like they have bills to pay, and they're not running on infinite VC money, and they're just like, yeah, obviously the revenue needs to come from somewhere, and if that somewhere is like there's some sectors of crypto that are doing very well, but the rest is absolutely doing like horrifically. So like depending on who you talk to, it's like a very different kind of like sentiment. Like you talk to the stablecoin people, they're like, oh man, this is a party, this is so great, like we're in Cannes, it's like early spring, it's a nice weather. And then like you go and talk to some whatever like DevRel of some L2 that has like whatever, I don't know, they're just kind of surviving off VC money from 3 years ago, and he's like, bro, I haven't found a single dev in like fucking 7 weeks. Like I don't know how we should, like I don't know what the fuck we're even doing. So it's like the sentiment in the industry is like very, very rifted and very, very split between like the individual kind of like verticals in the industry. Whereas before, I feel like the industry would kind of like move as one kind of like big tanker. Now it's like, I think it's like a lot smaller, kind of like compartmentalized things. And these kind of like general big conferences of like, oh yeah, we're just gonna meet as the Ethereum community, make less and less sense. I think like I'd be much more bullish about going to like an RWA conference or a stablecoin conference or like something like this where it's like thematically like more unionized, instead of like, I don't want to meet any more ZK researchers in my life. Like I'm okay with that.
They might become important once quantum scale become a thing, so yeah. But I get it. I think like the vibe in the ecosystem, especially Ethereum community, has shifted a lot. I mean, it makes sense in the past if you go to Ethereum conference and hear about the biggest update of protocol and like there's a merge and all that, but now it seems like we might be at the apps era, right? Like we don't, like the protocol is pretty much developed and there are problems to solve, but it's no longer useful for everybody. So but yeah, that's very relevant to context. I wanted to show you guys this dashboard. It's called State of Tokenization. So before I even dive in, a few acknowledgement. This is a dashboard that's built out entirely from my teammate Ali, who you guys met before, that was on the podcast, and along with all her AI agents, army of AI agents, and was also a lot of manual review on the data. But also the data source are mainly sourced from RWA.xyz and DeFi Llama for basically total value that's tokenized in the market for different asset class, different sector, per asset level information. So yeah, like a lot of works here. We're basically mostly aggregating a lot of available data out there in the public, but also adding an interpretation layer on top of the data. So this is called State of Tokenization, and we're hoping to launch this data portal either this week when this episode is out, or maybe the next week. But I'm hoping to have the link also coming along with this episode for people to explore. The initiative or motivation of building this is that all of us have been talking about RWA, and we know that this is basically the theme of this market cycle. But the talks are staying on very surface level. So we're talking about so much hype about like BlackRock is coming into crypto, and Apollo and is buying like Morpho, I believe, or something. And yeah, I think so. And but how many of these are wrapping the assets on chain, and just as like a ledger that's like mirroring the off-chain record, or it's even just flashy news, or how many of them are actually innovating how assets should live on chain? And so we built this thing trying to like measure and quantify. So on the landing page, we have a market map, which is like a tree map that is showing different category of the assets. And to be frank, like to start with, consolidating the asset class is very annoying as well. Like there are some RWA that is categorized as corporate bond, but on DeFi Llama, but then it's actually private credit on RWA. It's like very nuanced. So here, I think it's because it's unclear a lot of those RWA how the underlying assets is being like wrapped around, and like it can be a directly how to say the corporate is issuing this whatever like loan, or it can be issued through like a third party that's like a credible credit issuer. So if there's an extra layer, then it's different, right? Now it become private credit. So it's kind of annoying. So there might be some discrepancy in our data set from my check, but we believe we have the best like source and like categorization for the best effort. But you can see that we by default disable stablecoin, which is every data website do, just because stablecoin is so much bigger compared to all the other category. We basically indexed a total of 320 bill market, including stablecoin, but 185 bill of it is USDT, right? So like if you remove stablecoin here, you can then see like what are the assets that are being actually tokenized on chain. So the biggest category, the next is US Treasury debt. We call it basically Treasury. And if you see a Treasury on RWA websites, it's basically referring to US Treasury debt. And there's also other non-government Treasury debt, but it's like much more smaller. Commodities are basically like gold, silver, that type of thing, oil. And there's private credit that's being issued by like a company or so. And the biggest category here is Maple. And they basically have two tokens. That's one is Syrup USDC, one is Syrup USDT, are taking up like 70% of the category. It's very confusing though. It's called USDC, but it's not really a stablecoin. It simply just means that user can deposit USDC and USDT as a collateral to buy, to basically lend, to have a share of the Maple Syrup, like private credit share. Yeah. So yeah, anyway, and we built out a few really cool view. So there's a second view is called a heat map for the enterprise readiness index, but also like to apologize, like this is a moving piece. We're still like trying to figure out what's the best name for this metrics. ERI is what we are having right now, but we might call it like tokenization maturity index, tokenization progress index. So you will see when the report comes out. But the main idea of this index is basically to measure an asset through 3 dimensions. So we also put the methodology on the website, but I think maybe this is a better view to look at it. I think like I kind of like ideated this 3 dimension through the life cycle of an asset. So like if you think about launching an asset, like you need to have legalization, have some like legal documents about compliance and like how you built the trust and like form the entity and stuff. But then from there, everything goes on chain. You're issuing the token, and basically on chain, it means you're minting the token supply. And then you go from there. User can hold the token. They can transfer, trade on a secondary market. And then from there, maybe they can deposit that into a DeFi vaults and they can own your yields. That's the most ideal situation, right? And then if they want to exit, they can redeem that real like underlying assets with this token as well. So it's kind of like a cycle, but it's not necessarily that most of the RWA token can even like allow transfer. Like a lot of these RWA assets might just be like a token that can you can mint maybe with an admin approval, and you may be able to hold it, or they may hold it for you. So it depends on like if it's self custody or they actually custody by like a pool. And you may not even have integrated like smart contract infra even to allow like deploy and own yield, right? And even if they have, so how many lending protocol are accepting them as collateral is the next like coverage of the integration. So there's like a lot level of like how to say autonomy here for all the RWA assets. And actually like the biggest bottleneck here we've seen by surveying all these assets is that redemption is extremely hard. Like oftentimes it's easy to mint, but it's hard to get out. And so by measuring all these three dimensions, we kind of like categorize them into issuance, redemption. Like basically, can you get in and out like freely? And the other one is transferability and settlement, which means like
maybe on the issuance and redemption part, is that like the redemption process is hard because I need a certain size. Like I certainly can't redeem like whatever 100 USDC, right? But if I have like 250,000 USDC, Circle actually starts treating me like a customer and I can redeem it.
I think
like,
there's
is there like different challenges?
I think there's definitely that, but it's also more just like you're redeeming stuff. Now you're getting to the real world rails, right? That like they have to transfer it to your brokerage or to your bank account. Then there's like the bank holiday or like days off, like not 24/7. So like I think maybe also possibly this needs to verify is that like a lot of issuers might be holding these assets in other diversified investment, and they have to put the money back. And that's what happens like when I believe like recently there was a rumor about like the private credit crisis about Apollo, where a lot of people are panicking in the market or trying to withdraw their assets, but because all these people are withdrawing their assets, they didn't have enough underlying to withdraw for them because it's all highly leveraged outside in portfolio, right? And so that kind of thing. I think which actually says that a lot of this RWA asset can benefit the most is the one that's like very opaque, that is like being managed with private strategies and stuff. But now if it's on chain, you can pretty much track it across like votes and how like Gauntlet was doing like the risk assessment and all that, right? So kind of relevant, but transfer.
I think for like USDC and USDT, it's also just like whitelisting of who can mint and like who can mint and redeem underlying assets rather than like necessarily amounts. But usually it tends to be large amounts because it tends to be large issuer, I guess. But anyway, sorry.
Yeah. And then there's transferability and settlement. Because like, if you think about the initial idea of like why we want to tokenize asset on chain for the benefits of blockchain, it's about like costing the improving the cost, efficiency, lower fee per transfer, and like also instant settlement 24/7. So a lot of these now, if it's just a mirrored off-chain ledger, or like a dual ledger that it still needs to wait for the off-chain version to update, then it's not really achieving the goal of the 24/7 settlement and all that. And then the other part would be like complexity and composability, which is basically like how much of these underlying assets are actually working on chain earning yields. Like, are they put in DeFi vaults or not? And I don't know if we had the exact last episode, JW was talking about that out of stablecoin, which is a 290 billion market size, only 10% are put to work, like are being used in DeFi. And we have a discussion about that part, actually. This is actually pretty interesting finding. Obviously, I think if you account the different asset class differently, this results will look different. But out of all the 11 asset class we account here, which includes stablecoin, treasury, commodity, private credit, non-US government debt, tokenized stocks, active strategies, corporate bond, private equity, real estate. Stablecoin obviously has the highest absolute value in terms of locked-in DeFi, 26 billion, but that's a relative low percent for the total value of stablecoin. But then the next one would be private credit, and it's around 60% being locked in DeFi out of the total value that are basically tokenized. And again, like this is a little bit distorted by a few major, assets in this category, including Maple. Maple together was like 1.6 bill. And there's like a few other assets that has like pretty native like integration with DeFi vaults. So it's very interesting. But I think the takeaway from here is not saying that stablecoin is less DeFi integrated or composed, but instead, like you can see that like stablecoins has different utility rather than just investment asset. Because a lot of the stablecoin are actually acting like cash rather than saving assets, right? Like you have to put them in your wallet and like transfer every day and like actually use them. But private credit and others are showing more attributes that's just acting like more like a like assets for investment. So that was pretty interesting. But yeah,
maybe can you have this heat map style thing in the background? Can you run us through like a few examples of like an asset that scores high on transferability but maybe low on composability or something like this?
Yeah. So let's see. So also like the functionality is so advanced that I think it's a little bit hard to understand it at first sight. So we have 3 dimensions here to present. So you either show like multiple coordinates of 2D or you show a 3D. We think 3D is too confusing. So here you basically can change the coordinates to be different, measurement dimension. So if, as you said, we look at like asset that is like having very low transferability but higher composability. So if I click into here, I would say like high transferability would mean this one having a high score, right? Like the y-axis having high score, but so it doesn't exist, if that makes sense. There's no assets that's falling into like a 1 complexity but high, which makes sense as well. Like it usually moves first with transferability but then complexity. But okay, let's look at like the highest rating for composability and transferability. So this one USDS, which is MakerDAO, which I think it was DAI, right? Yeah, so it used to be DAI, but now they rebranded a bunch of times. But this is a native asset that is sitting on blockchain that allows you to basically issue and redeem permissionlessly, and you can transfer and settle, and you can compose them with almost all the DeFi protocol. So that kind of makes sense. The other one is Frax, actually.
Yeah.
The issuance redeem actually is not as autonomous as USDS, but transferability and complexity is like very high scored. We can look at a bunch of other assets. Let's see this one. So Aave actually have this RW asset called Horizon. This is lower in the issuance and transferability, but it's like more native to compose with DeFi. There are some like more annotation in the reasons why, and a lot of these are actually LM sourced. Again, like we tried our best to audit most of the information, but obviously if there's any like information that's like, coming up from like some scraping, would more than happy to like get feedback. But I think it's more important to look at the distribution of the whole data set. So you can see pretty much like complexity and transferability moves all together. So it's kind of like correlated. And if it's low in the transferability, it's low in the complexity. And the central gravity is falling through in the lower end. And issuance is like kind of interestingly all over the place compared to the other 2 dimension. And there are like stuff that's like pretty high transparency, but the issuance is still pretty gated. So this one is the Frax one we saw. Athena is kind of that way. I don't know if you agree, Dobby, but yeah. So
okay, interesting.
And we have another view that's called ecosystem. That's just more just like a network graph to show different cluster of assets that's being tokenized. It's relatively the scale comparison against each other. And then there's a database view that you can go through every asset and look at their value. One very interesting data point that we scraped, aggregated through DeFi Llama is the active TVL, which is basically the total TVL that's deployed into DeFi, which is what the other chart I just showed you guys. The other very interesting thing here, though, is to look at the per asset page and have Ali built this comparison tool. So you can compare this, RWA was another one trying to see like which one is more native. So Aave here compared to Circle is a lot more native. Circle had a rating of hybrid compared to the other one, even though it has way more market size. So yeah, we would love a lot of feedback on this, and it's aimed to be updated quarterly. And then I have a bunch of takeaway that we draw from analyzing this data set.
I think my main question coming out of this first is when you say locked in DeFi, there's many ways to lock in DeFi, and I would love to see like how much is in lending and how much is in like trading pools, or all these different like sections of DeFi, trying to segment it out, because I do believe that different tokens are going to be used very differently in DeFi, and that would be an interesting tidbit of information, as well as even maybe having like protocol side view, or like lending market, like which are going to be the collaterals that you see mostly in the RWA space, and
like
this is really, really cool.
How many protocol accepts it as a collateral? And I think, I mean, again, like we're not the one doing the heavy lift here. Again, we're sourcing this data from DeFi Llama. So obviously, whenever they do have the information of like total locked in DeFi breakdown by protocol, like it is in Aave, it is in different markets. We can definitely incorporate that data set. But I would also say that this tool is meant more for the head of digital assets at banks rather than people like you guys.
Yeah, of course.
So,
no, of course.
Yeah.
I think there might be though some relevancy to has it been like Aave approved or Morpho approved, since that does also set some baseline for they don't accept just any assets randomly. They have checks in place to ensure they have good collateral, and I think there's some value to it that TradFi can learn from the the DeFi space. Why did Morpho choose this one? Why did Aave choose this? What are the risk factors that they mentioned there? Especially I don't know. Lending is a market where this is very fundamental. And kind of like rating asset is specific to crypto, and it's kind of different to how it's done traditionally. So maybe they also have some information that can be pulled and added there as like, Aave approved or whatever.
This is a life cycle chart I was talking about, right? Like we're measuring against different key actions here. And so to evaluate truly if the asset is native on chain or not. And based on all these scoring, based on, like protocol docs, like news, information online, data, we used AI to score us on all those like 3 dimensions. And we cross-checked a bunch of projects and they looked pretty convincing. And this is our final summary of the data set. So 77% of the total asset market that we looked into are still in the wrapper phase, right? So it's just like a wrapper of an asset that's not really acting as a native asset on chain. But obviously, stablecoin had the most advanced tech on that. And there's other categories that's like progressing on that aspect. So
For those wrapper assets, do you know what is the intent? Is it just to be used as like a ledger, or is it because they want to actually show face in the crypto sector and later on, actually develop those into being more crypto native and usable in DeFi? Like, what would you say is the reason for this?
I mean, I think like the intent was definitely all to trying to become like a really native asset, but like they're just at very early stage yet. And they need to have everything KYC to controlled and like still following through whatever the traditional rails are. The other thing is I've heard like from informations that a lot of RWA projects that are launching, they may have an intent to utilize blockchain for access or distribution. So heard this like anecdotal thing where like Alipay was also launched and probably assets, but like kind of didn't really go to the end. But from someone who was working closely with them, they were saying that like it seemed like they're just trying to sell an asset that had a no demand off chain, and they're trying to like getting exposure on chain. But obviously that's not going to work if your underlying asset doesn't have demand. Tokenizing it won't really give you demand, right? So I expect there might be stuff like that. Yeah. So otherwise, we can see like the total scale.
Maybe let me. I feel like wrapper is like a little bit of a sounds like very negative, but like aren't we trying to bring real world assets on chain? Like isn't like kind of the implication of like bringing a real world asset into the blockchain world isn't the goal to have like a wrapper? Like I'm a little bit like I guess you can natively issue things on like the on like on-chain rails, and like that is like the prime, like that is the only representation of this. But it feels like this is like a reasonable step from like the old systems to the new systems, where like for regulatory reasons, and like I think a lot of this will essentially be regulatory because you like need to have like a prime kind of like trading venue where it's like okay, like we're issuing whatever government bonds. We can't issue the government bonds on whatever Tron. Like this won't be.
Why not?
Like, I don't know. It feels like this is just.
It's just a wrapper for now. I think that's the point. Is that like the asset is wrapped but unusable in any capacity for now on chain, other than just existing as a representative state. So it's like can't
you still use it like in a composability, and like you can still trade it 24/7, and like you can still do all of these things, right? It's just like on the other side, like all of this.
No. That's why it's called wrapper. It's like you actually only wrapped.
You can't do anything with them.
Like,
No.
Some of them.
Okay. What's the point?
Don't even exactly. Yeah.
Okay, now I get it.
Yeah.
What?
Like it's not like you can hold them in your wallet and you can transfer them even. Like it's possible that they may just have like a on-chain ledger. And it's not even in your wallet.
Okay,
yeah,
that's crazy.
Preparing for the future is my most probable view.
Yeah, and it's also like exactly like you would imagine everything is like what you are used to, but not really, right? Like if you're trading like a tokenized gold and you're like transferring it, I think like there's also different level of autonomy here, which is like. Do you want to have the off-chain brokerage account also mirrored with like the gold being settled in your wallet in real time with your on-chain movement? I think that's like a next level. We may argue that maybe that doesn't make sense, but there's many layer to that, I think. But yeah, like all we wanted to do with this report is basically like to look at this picture. The full picture we're seeing is that there's so many assets launched every year in the past few years, and the total market value of tokenized assets are up only. And going through all these signals, how much are noise, how much are real?
Is it asset launch or amount, like dollar value of those tokenized?
This one. So I have left axis, y-axis is the number.
Oh, sorry, I didn't see both axes.
And then on the right side is the value. Yeah. And if you categorize them, you can see like a lot of them are sitting across different category: treasury, commodity, private credit, and tokenized stock had a higher ERI compared to others. You can see the second highest growth in terms of tokenized value would be treasury. We kind of mentioned that. This is kind of interesting chart, which is like a year-over-year market value growth by asset class. And I think like, obviously I did the log scale on the y-axis because how big stablecoin is, but you kind of can see a bunch of information from this chart, which is stablecoin started so early in 2018 when DAI and others like started. And it kind of took a dip in 2022, which is like when the whole crypto market took a dip because of FTX and all that. Treasury also, that's not treasury. Private equity started also pretty early. They kind of trended together, and also I think this other one's tokenized stocks, yeah, like trended down in 2022, but soon after 2022, there's many more assets are actually taking off. I think that's like the real like start of the second wave RWA as a word. I think I mean I remembered RWA being talked like before 2022, but then 2023 was like everybody starting to build RWA, and you can see that like some categories kind of are saturated now. By saturating, I meant the trend, the growth trend is going down. It's still growing, like with a very positive rate, but the growing speed of growing is kind of trending down. Which, for example, Treasury is like started at like very high rate, but now it's kind of like slowing down a little bit. And same as like I think this one would be darker colored tokenized stocks
Tokenized
actually.
stocks.
Yeah. The other one was active strategy, which means like a lot of fund made. It's kind of like liquid fund in my opinion. Yeah. And
So it's in 25. It's only commodities and private equity that really rose a lot year on year. Maybe a bit as well from I don't know some others, but that seems like the major ones that rose last year.
Yeah, and the nascent asset class would be like real estate and non-US government debt. So like I think, and the other one is a corporate bond, which it doesn't have data set, but just one data point up on the top, which is kind of crazy. And I think like real estate is hard to tokenize, kind of makes sense because it's so much like transferring the deeds and transferring this and that legal docs. It relies upon a lot of like traditional rails. And so I think there is like a gap between the infra for tokenizing those assets until it can actually take off on chain. The other one that was like,
I mean, real estate is also non-fungible. Like, I think that's like a real big problem. Like, if you buy a house, you don't buy a house. Like, a house is not equal to a house. Like, it's like very depend like which neighborhood, how big is the house. Like, it's like a lot hard. Like, I think there's ways where you like essentially like some developer has like a portfolio and it's just like okay, like a portfolio of commercial real estate in Detroit or something like this. And then you can just kind of like buy that as a product if you like bullish on whatever commercial real estate in Detroit. But generally, I think, yeah, the financialization and the financial engineering in the real estate business is like a lot less sophisticated on average than, especially like I think like private real estate versus commercial real estate. I think commercial real estate is like there's like some financial engineering that goes into it and it's like quite professionalized, but yeah, individual real estate or like private real estate.
Yeah, that's a good
very
point.
difficult to do that.
Yeah, and I guess like the liquidity and like how much of a flipping like the frequency of exchanging those things are different for different assets. So, but yeah, that this was the chart I was talking about without showing, but you can see that value in the amount of value locked in DeFi versus the total market size, private credit actually like standing out pretty surprisingly here compared to stablecoin. Yeah.
Wait, this is driven by Maple was like the big issue of private credit?
Yeah. Maple was the biggest one.
So this is like a vertical. I feel like I've heard Maple mentioned in the context of like a lending market before. So is this maybe just because there's kind of like a vertical integration happening and they're like issuing these with like the intent of already kind of like allowing these looping strategies and stuff? Or
that's a good point. I guess we need to look at like DeFi Llama to see which does Maple really getting locked in. So DeFi active TVL 1.7 and where are they locked in? It's Jupiter. I think it's Jupiter.
I think Sky as well, Maker. I think Maple might be a collateral for DAI, USDS or whatever.
Oh yeah, it seems like they have a lot of protocol that accepts it. Morpho, Camino, Aave, Euler, Jupiter Land, and a bunch of like actually this also include the total value that's locked in AMM. that is like earning LP fee. So they also have money in like Uniswap and Aerodrome and all that.
Is there any double counting with, for some being used as DAI collateral, for example, or in other scenarios where, therefore
I would
Maple will
imagine
be.
I would imagine this is only counting the syrup USDC asset.
No,
So,
I know, but I think that's kind of asset, like
oh, I
USDS is
see.
also backed by RWAs, right?
Well, so the syrup Maple token specifically should be backed by private credit.
No, I
If
mean the other way around. USDS has backing, including other assets, which are in
oh,
parts RWA, and therefore may include Maple syrup. I don't know, or others.
oh, I see.
My point is, you may have some double counting there in some
Oh,
occasions,
so
especially in the
you're
stablecoin space.
so you're talking about because stablecoin are often not just backed by cash fiat USD, but actually multi-asset on chain.
I wouldn't say often, but
Mm,
DAI is USDS,
I
sorry,
see.
is a case, and Frax maybe as well, given its more decentralized nature, I guess. But
I see.
you like USDC and USDT, I doubt they have any RWA as much as I know.
Yeah, I see. I see. But yeah, that's pretty much what I want to show. And I think like the discussion, I've been following JW's research. He's been writing something similar along the line. I think like he was discussing a few other metrics that's worth talking about. Like today, if you're talking about like the progress of RWA, it's all about total market size or total market value or like value tokenized. But how how quickly actually can your token move, and how low is the cost? These are like the initial motivation of tokenizing, and like how many on-chain wallets are actually holding the asset. Like first of all, these assets may not be actually held by user, but if so, are actually people using it? Are people actually demanding it? Like how many people actually want this? I think that's another thing nobody has talked about. And the other is like how much transferring and trading volume all these assets actually have, which also measures kind of like the usage and how much are actively deployed in DeFi. So I think those are the conversation we need to have that's beyond just token value market side. So yeah, that's everything I want to like bring up. And like this playbook thing, like, this whole report should serve as like a playbook and like a guide for the trad bank, like head of digital assets. That's the intention of our team. And I think there was some other interesting discussion that's related to maybe perp decks, which is we've seen that like there has been a lot of trading volume for private equity. So like OpenAI, Anthropic, perp volume that are being now kind of like
Yeah.
primary index or indicator of an asset. And I think like you guys been looking into some hyperliquid HIP3 data that we may talk about in the future, and where
Yeah.
like so I think yeah, a lot of real world assets volume are moving towards perpification, which I think is a word coming from Guy from ACCD. I think like the argument there they have is if you wanted the asset to move 24/7, actually perp is a more crypto native form of an asset for you to tokenize it towards. And so that's argument there, but I need to also like
Yeah.
understand more better there.
I think as like a quick look, but we'll dive further. Is like oil already has almost $1 billion in open interest on perps, just out of current world events, and gold, silver, and other assets are getting increased interest through hyperliquid rails and also lighter and other perp venues. Yeah, so I think we should dive into this next because perps aren't just for crypto anymore.
Yeah, I think that's a very interesting development where it's like TradFi players are now starting to look at Hyperliquid just because the form factor of a perp is so much better, or like so much more simple to handle as well from operations side than like trying to deal with like expiring options and derivatives and like all of this crap. all of this crap. It's been running the world for the last 50 years. But as a like modern crypto bro, you're not used to anything else but perps. So but now actually like hedge funds and stuff, they're starting to look at like Hyperliquid as just like their primary trading venue for perps. But there's a problem where like Hyperliquid is not regulated. A lot of these funds can only they can only have a small percentage of their overall trading volume on perplexes and stuff. Or like not perplexes, on perp exchanges like Hyperliquid, and essentially. So now I think there's traditional players who are actually looking into kind of like, can we integrate the Hyperliquid trading structure? Can we like partner with them? I think there's like a very interesting kind of convergence that's happening into like, on-chain finance and traditional finance, where like the traditional finance people are coming on-chain, and sometimes they're just launching wrappers. Sometimes they're like actually thinking ahead, and like we have some whatever composability, and like you can integrate the stuff into DeFi. I think a lot of it is like really held back by regulation. I think a lot of these people would probably want to move faster, but there's just so much heavy red tape around all of these things that it's like, okay, like this is like a 12-month process to launch like your first Aave pool. And these processes have probably only started like a couple months ago. So I think like, as everything, there's like a lot of talk and a lot of hype around these things first, and then kind of like actually people need to do the work. And I feel like we've gone through this hype cycle of RWAs like a bunch of times now. So now we're actually starting to see like, hey, there's like $25 billion of assets worth of like non-stablecoin RWAs on chain. Just like that's a reasonable number. But yeah, as with everything else, like these things just take a lot of time. And I think the usual kind of regulatory arbitrage that crypto people have done on like scaling whatever worked, I think prediction markets, stablecoins, basically just like shitting on, or like not giving a fuck about what's legal and what's not so legal. And in RWAs, I think that's like a little bit harder. So I feel like the development cycles are going to be a little bit slower here than we would probably like. But that's just my take from kind of like reading between the lines. Maybe we get some wondrous runners of on-chain yield.
What do you guys think are the other talks for the cycle besides RWA and agentic payment?
I mean, which cycle? Like
the
Japanese soldiers are all dying, Danny. There's no cycle anymore. You need to be in a safe like, I don't know. I feel like the industry is really, really not distributing. It's like diverging. Some areas are like, there's like a local bull market in prediction markets and stablecoins. Those people are hiring like crazy. In RWAs, there's like a lot of activity, but everything else is just absolutely taking like, ask any meme coin dev, ask any meme coin launchpad dev, ask any meme coin, like all of this. I mean, there's still miraculously, there's still like quite some volume on PanFun, but even that stuff, like I don't know, it's just not in the news cycles, not on my feed. It doesn't seem relevant in any way, but I think, yeah, we'll I don't know. I don't think there's a cycle. I think the cycle is really that. I think now it's like, okay, on which chains will the like financial infrastructure of the future be built?
I'm doubtful of Pump Fund's volume stats, but that's beside the point, I guess. But anyways, I feel like things aren't doing great, but there'll definitely be a lot of things that will also come back. It's just forever cycles where you reach depression and then you go back to euphoria and then usual stuff. And we'll have a lot of crypto native stuff come back in some form. That's just part of market maturing. But of course, yeah, TradFi assets is probably right now where things land, and it's kind of cool that through the legal aspect of crypto maturing, and as well as I guess throughput and chains like Hyperliquid, we're now enabling more TradFi stuff to be moving on chain. But there's a lot of other cool stuff that crypto has to offer. It's just maybe not in the spotlight right now.
Okay. Dobby is essentially saying the Kaiser is still alive, or the Emperor is still alive.
Yeah,
you're gonna fight till the last. Okay, have fun. No, I mean, fair enough. I might have a little bit more of a bleak outlook as a if there's picks and shovels, no, if there's a gold rush, we try to sell people picks and shovels. But our customer base is basically going bankrupt every 12 months. It's like it's a little bit of a funny business. But yeah, we are like, I feel like I'm taking more of the grunt of the we're like a little bit closer to the metal. You're probably seeing this in your deal flow and like the funder updates. Oh yeah, that probably is interesting to read what all of those people are up to now. But yeah, that's just my humble perspective.
Yeah, I mean, you have a lot of you have some deals going on that are not necessarily out in the public and stuff. Is like usual like bear market stuff is you have some deals and people are building but not necessarily sharing much information. So you build in the hope to share stuff when things are better. And I think there's a lot of cool things that are still relevant, and I wouldn't be in venture capital if there wasn't anything to invest in, right?
I just saying like the use. I don't know. I'm having a really hard time seeing like how we can have like a meme coin mania or an NFT mania again. But I feel like I probably said that when like the NFT mania was over. I probably said like, oh, we're never gonna have this crap again, and then like 6 months later the meme coin mania just picks up, and it's exactly the same playbook, just the like asset class slightly changed. So maybe we're all gonna trade like stocks of whatever tokenized Teslas that are driving people around in San Francisco in like a couple months. But we'll see.
There's a lot tokenizing real world assets, like it could be, there's a lot of NFT infrastructure that can be leveraged rather than just liquid assets. It doesn't just mean trading JPEGs. There's like actual stuff we can tokenize and leverage the NFT infrastructure for. And of course, I do think there's also a future in the art aspect in the long term future, but it's clearly not right now that it's being shown in full light, I guess.
Oops. Yep. We shall see what the future holds. For now, any last works on the state of tokenization, Henning?
That's it. I'm also curious to look at the Perp Dex stuff in the next episode. I think it feels like that's a missing puzzle in this.
Yeah, how much of traditional finance volumes are actually moving on chain? We shall find out. But yeah, this has been the Index Podcast. Thank you for listening. Join the Telegram group, and we will see you in 2 weeks. Bye-bye. Crypto data wizards, come join us for the parade. From Bitcoin ETF to Solana meme coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar. We call them out and set chart climb on fire. Index Podcast, crypto data